In 1921, the Imperial Bank of India was set up by John Maynard Keynes, an English economist. His ideas affected some fundamental shifts in economic policy around the world. It was Keynes who proposed the establishment of the World Bank and the International Monetary Fund to oversee and encourage world trade. Now, the Imperial Bank was formed by merging three presidency banks of India: the Bank of Calcutta, the Bank of Bombay, and the Bank of Madras, all established in the 1800s. It was a commercial bank which dealt with the public, accepting deposits and offering loans and other services. But while it was a commercial bank, the Imperial Bank of India served some functions of a central bank for British India. So what is a central bank and what does it do? To put it simply, a central bank manages the flow of money in an economy. It issues the currency and affects spending by controlling interest rates. It can also be called a banker to other banks because it licenses and sets guidelines for all other banks to function by. Largely speaking, it sets the monetary policy for the country. For these very important reasons, it is imperative for any country to have a central bank. The Imperial Bank of India would go on to be rechristened the State Bank of India in 1955. But the story we have today is not about that. It is about the Reserve Bank of India, India's own central bank. Hello and welcome to A Century of Stories brought to you by IDFC FIRST Bank, always you first. I'm your host Kunal Vijayakar, and today I will tell you about the RBI, or the Reserve Bank of India. The RBI has shepherded India through some tough times. Through domestic challenges and global financial crisis, it has guided us and shielded us to come out relatively unscathed. Hello there! Get ready for a financial game changer. Introducing monthly interest credits on your IDFC FIRST Bank savings account. With IDFC FIRST Bank, your savings account isn't just a place to store money. It's a place where your money grows every month. A unique monthly compounding interest means that you not only earn interest on your balance, but also on your previous month's interest. Imagine the possibilities. You earn interest on interest, which can significantly boost your savings over time. It's like your money is working harder for you. Open your savings account today at idfcfirstbank.com. The idea for the Reserve Bank was first floated in 1926 in the recommendations of the Hilton Young Commission. The issue was brought up again in 1931 by the Indian Central Banking Inquiry Committee. But it was only in 1933 that it was finally introduced formally in the White Paper on Constitutional Reforms, a submission of the Simon Commission. On that basis, the RBI Act of 1934 was passed, and on the 1st of April 1935, the bank started its operations. First headquartered in Kolkata, it moved to Mumbai 2 years later. At this time, the majority of its capital was still in investments from private owners because India was not yet an independent entity and did not have a government of its own. After gaining independence, the RBI Act of 1948 was promptly passed and the Indian government took over the RBI, buying out the share of the private stakeholders. On January 1st, 1949, the RBI started operating as a government-owned, nationalized central bank with the power to regulate and structure all other banks under the Banking Resolution Act of 1949. Interestingly, Burma separated from British India in 1937, and Pakistan was formed after the partition in 1947. But the RBI continued to serve the economy of Burma till April 1947 and Pakistan till June 1948. Think about that. As the Indian Constitution came into force in 1950, So too did the planning era. India put into practice 5-year plans, an idea adopted from the Soviet Union system. This was done to improve the socio-economic condition of the country in an organized and objective manner. The first plans focused on growing the agricultural sector. The Reserve Bank of India, needless to say, played a supporting role with its lending policies. In the 1950s, bank failures were common among smaller and weaker banks. This led to panic among depositors. They were worried about the stability of their savings. To allay these fears, attract deposits, and solve the problem of low capital, the government passed the Deposit Insurance Bill of 1961. Over the next 2 decades, the RBI worked on restructuring and strengthening the overall banking sector by merging weaker banks with larger ones. It was also at this time that India fought 3 wars, faced a nationwide drought in 1965, a global oil crisis in 1973, and the emergency in 1975. Through it all, the RBI stabilized the economy using its monetary policies. But it took a toll. By the late 80s, a balance of payments crisis was starting to emerge, which meant that our foreign exchange reserves were running so low that we could not afford essential imports. As a short-term measure, India leveraged its gold reserves to avert the crisis. But this situation also led to a larger overhaul of the economy towards liberalization in 1991. Finance Minister Manmohan Singh introduced reforms to open India up to the whole world. And of course, this changed the role of the Reserve Bank of India as well. From deciding on all matters, the RBI would now set guidelines and decentralize decision-making, allowing banks greater freedom. Banks could now set their own criteria for functioning, with RBI as more of a steadying presence in the background. By 1994-95, the exchange rate was determined by market forces. Licensing rules changed and new private sector banks came up, both Indian and global. Banks were allowed to set their own lending and deposit rates, and they could now open new branches without the RBI's permission, so long as they met the guidelines. But even as it took a backseat, the Reserve Bank of India continued to make process improvements and innovate on technologies within the financial sector. This pushed the Indian economy to move with the changing world and made banking in India safer and simpler for its users. In 1999, to take the pressure off cash, RBI thought about another way to circulate money in an economy. It issued guidelines for the issuance of debit cards and smart cards. Soon after, with the turn of the century, internet banking was introduced in 2001, modernizing the customer's interaction with the whole banking sector. In 2005, the RBI moved transactions from the physical realm to the online space with the introduction of NEFT, or National Electronic Fund Transfer, revolutionizing the way banking was done. With the advent of new technology, RBI embraced the digital economy. Even now, when debit cards have given way to UPI as another medium for money transfer, the RBI closely monitors and regulates this payment system, making it safe for use by millions of us. Like we learned on our earlier episode about the UPI revolution, the RBI has secured UPI transactions with 2-factor authentications, fraud detection systems, and strict KYC norms. The Reserve Bank of India indirectly touches the lives of all banking users, even if it doesn't directly interface with customers. The story of the RBI is a long and intricate one, evolving with the times for the better part of a century. As a dependable and robust institution, the Reserve Bank of India has nurtured, cultivated, and secured the banking ecosystem for all of us and continues to do so as our growth story unfolds. You've been listening to A Century of Stories, brought to you by IDFC FIRST Bank. Always you first. I'm Kunal. And next time, I'll tell you about a man whose achievements were of astronomical significance to the nation. Come back next week to find out who I'm going to be talking about.
IVM